For your business to grow and thrive, you must master your numbers. Hi, my name's Jeremy Gray. I am a fractional CFO. I have experience of working in Europe, North America and Asia, and I am currently based in Vung Tau, Vietnam. Over the next 12 minutes, I hope to be able to help you understand your financial statements so you never need to be afraid of your numbers again. Businesses rarely fail overnight. The signs that your business could be heading for the rocks is usually clearly signposted in the financial statements for those who know how to understand them. But first, I have a question for you. Who are you more afraid of, your doctor or your CFO? Many folks, particularly older people, such as myself, put off visiting their doctor, fearing a scary diagnosis and potentially painful treatment. Entrepreneurs can feel the same way about reviewing their numbers with their CFO. Maybe an unpleasant truth is buried in your P&L, a sad truth that will require you to make difficult decisions. In either case, whether it's visiting your doctor or talking to your CFO, the sooner you bite the bullet, the sooner you will get an all clear, or if there is a problem, the sooner you can start to fix it. Paul Graham, the founder of Y Combinator, says he can size up a company by whether they are default alive or default dead. If the status quo of revenues or expenses is maintained, will the company live or will it die? Amazingly, 50% of founders do not know the answer to this question. Do you know the answer to this question for your business? Even if the answer is live, is your company fulfilling its maximum potential? If you want your business to grow, to scale and to succeed, you cannot be afraid of your numbers. So how do you get started? Firstly, I recommend you get rid of the jargon. Finance folks, like doctors, use their own language. This speeds up team communication, but can also be used to keep outsiders at bay. Don't be afraid to speak up and ask for clarity when someone's using a language you don't understand. Saying something like, "I'm not quite sure what you mean. Can you explain it to me in simpler terms?" This can go a long way in helping you follow along with the conversation. Keep in mind that people might use jargon to exclude or to confuse you, or even to cover up their own insecurity. Don't be afraid to ask for clarification. After all, you're paying these folks for actionable advice. Next, ensure your monthly financial information is available promptly. Information that is weeks old is useless as a basis for decision making. Timely and accurate financial reporting will enable you to make practical decisions and implement improvements across your business, rather than conducting a post-mortem once a problem has turned too tragic to address. Once you've eliminated all unnecessary jargon and got your most recent accounts to hand, it's time to start understanding your financial statements. Start by looking for trends. I like to compare the most recent month with the prior month, the same month in the prior year, and the budget. You do have a budget or annual operating plan, don't you? If not, no problem. I'll give you all you need to know about preparing a budget later in this podcast. For your profit and loss, there are 4 key elements that you should focus on: sales or revenues, gross profit, which is sales less the cost of producing the goods or services, overheads, which is everything else you spend money on, and finally your earnings, which is the result of the 3 items we've just discussed. Really, that's all there is to it. When it comes to your financial statements, remember, revenue is vanity, profit is sanity, and cash is reality. And when it comes to managing cash, there are 3 important items on your balance sheet. That is your working capital. Working capital has 3 elements: the money you owe to others for materials and supplies, often called your accounts payable; the money people owe to you for the goods and services you have provided, often referred to as accounts receivable; and the value of the raw materials held in your warehouse. There will be many other lines on your balance sheet, but working capital is the area that deserves the most of your attention. Working capital is a necessary evil. You need it to keep your business operating, but it ties up cash that could be better used elsewhere. Managing your working capital effectively can breathe life into your business. Let's take a deeper dive into those 7 elements. We'll start with sales or revenue. Steadily growing sales is usually a good sign, particularly if the sales growth is in line with or exceeding your forecast. But be aware of unprofitable sales growth. I once took over a mining business that was delivering unacceptable levels of profitability. By the end of next year, I had decreased sales by 10% and increased earnings 14-fold, in part by eliminating unprofitable sales. Gross profit, or sales minus production costs. For this metric, there are no ifs, buts or maybes. Gross profit as a percentage of sales should be trending upwards. Gross profit percentage is often referred to as the quality of earnings because it is a major element of profitability. I use the word trending upwards for a reason. Competition will limit how fast you can grow your gross profit percentage. For an established business, a 0.5% improvement per year is a very good result. When it comes to overheads, the key metric is your spending as a percentage of revenue. If your business is growing, your expenses will likely also be growing. You want to be sure that your business is taking advantage of the economies of scale that will be available to you. If overheads remain flat as a percentage of sales or even are increasing, you're missing an opportunity. Take the time to look at individual line items to identify areas of weaknesses. Is it your staffing costs that are growing faster than sales? Marketing costs deserve particular attention. Often marketing costs accelerate as businesses chase growth. Once the customer acquisition costs exceed a customer's lifetime value, it's a downward spiral. You would think that no one would get this balance wrong, but it happens all the time. Remember, revenue is vanity, but profit is sanity. You will grow your profitability by managing these three elements. It's not difficult, but it does require attention to detail. So, if profit is sanity, cash is reality. Managing your cash is critical. The day your business runs out of cash is the day it closes. One of the major drains on your cash is going to be your working capital. To manage cash, negotiate improved payment terms from your suppliers, ensure your customers pay you promptly, and keep inventories to a minimum. Regarding inventories, here's a tip that I've found works consistently across all industries and across all geographies. Keep the size of your warehouse to a minimum. If you give your operations manager a large warehouse, it will quickly be filled. Keep the warehouse small and your ops manager will soon be skilled in inventory management. There are some key metrics that you can use to monitor the effectiveness of your working capital management. For money owed, use days sales outstanding. For payables, use days payables outstanding. And for inventories, use days on hand. There you go. See, finance guy using jargon again. But you'll be able to find the formulas for calculating these pretty easily if you go onto the internet and use Google. Earlier, I promised you some tips about setting budgets or your annual operating plan. If you give folks free rein to set budgets, things will get out of hand. The result will either be an overly optimistic plan or one that is so conservative it can be met without trying. Here are the guidelines you should use. Plan to grow your revenues twice as fast as your market is growing. For example, if your market is growing 3%, plan for 6% revenue growth. Aim for realistic gross profit improvement. I mentioned 0.5 percentage point is a good result for most companies. Then manage your overhead so the profitability is growing twice as fast as revenue. I mentioned 6% revenue growth. If you're aiming for 6% revenue growth, you want 12% improvement in your profitability. If you use these guidelines, you will have a budget that, as Goldilocks said, is just right. To conclude, financial information is an invaluable tool that can help you determine where your business stands today and predict how it's going to operate in the future. Properly assessing and analyzing the financial data generated by your company allows for informed decision making, increasing the chance of success for your business to allow it to grow and thrive. Do not be intimidated by numbers. They are a powerful asset. Working with an accountant or a CFO can help you improve your profit and loss and cash flow management. Use key metrics to provide insights into profitability and progress. Doing so will ensure a sustainable future filled with growth opportunities for your company. Do not be afraid of your numbers. If you find yourself putting off understanding your financial accounts, seek advice now. Otherwise, it could be too late. I hope you found this advice helpful. My name is Jeremy Gray. I'm a fractional CFO, and you can contact me via jeremygraycfo.com. Thanks for listening.